Okay, so we're keeping on the data theme. So we heard from the previous panel how there's some really innovative things happening when it comes to underwriting and the new data sets that people are using. But when the rubber hits the road, it's the traditional data that really people are using today. In the majority of cases, they might be overlaying some of this new data. So what we're doing now, we're going to bring out some of the more established companies in this space. This space would cease to exist if these companies weren't doing what they do, weren't providing the data that they provide. So I feel personally this is a really important panel. Find out what some of these traditional companies are doing to really push the envelope forward for them. So I'd like to introduce Angela Serezny. She's a co-founder and CFO of Orchard, and she's going to be running this panel. Thank you.
All right, hello everyone, and welcome to our Trends in Underwriting panel. My name is Angela Serezny, and I am the co-founder of Orchard. My background prior to Orchard is in consumer and small business underwriting and analytics at American Express and Citigroup. In fact, while I worked at those companies, I worked with some of the firms that we have up here. So we've heard a lot of interesting information in the last two sessions discussing the trends in alternative data, but now we'd like to focus on what many would call the traditional data and service providers. So I'd like to welcome our panelists. We have Jeff Knott from Equifax. We have Joe Polverari from Yodlee. We have Mark Ryan from Fair Isaac, and we have Charlie Wise from TransUnion. So many people in this room are probably around for the alternative big data panel, and there was a lot of discussion about data from tweets, Facebook, and college transcripts. I want to know what all of your thoughts are on this type of data and what you see as the future of underwriting. So.
Sure, just to lead off the conversation, I would agree that certain elements from social media, from educational transcripts, from other things beyond just a historical look back are important, but I would not necessarily agree that the way to obtain all that information is from a self-reported mechanism or from obtaining it directly from those sources that may not be validated.
Great.
From Fair Isaac's perspective, we probably have an enviable position in that we generally operate within a data agnostic environment. Our modeling capabilities and approaches are generally used regardless of the data source. So there's many different data sources for which we leverage, many with the companies represented today. So again, we have a neutral position on the use of data. Our role is to continue to develop tools and analytic approaches that can be used leveraging any data source. So that's fundamentally where we put our energies.
And I have a question about that. Can you give some examples of alternative data that you guys use to do your modeling or analytics?
Sure. As it sits today, we have roughly 24-ish different types of data sources that we actually will leverage. And they range everywhere from traditional credit bureau data through data from companies that look at, for example, the buy here, pay here type aggregation of data in the auto space. We also look at data from sources such as evaluation sources on vehicles, if you think outside of this particular industry. And then within this industry, we actually work with a couple companies here that are using non-structured data that comes from the areas such as Facebook and Google and other sources.
But can that data be used in underwriting? Like, so if you guys create a score that a company here that a company here would leverage that includes Facebook data, can they use that in underwriting to make a credit decision today? Or is that more for customer acquisition purposes or something else?
It could be used for any of those. Again, we don't provide guidance around what they can use the score for, so that would be inappropriate for me to pass judgment on that.
Okay, good.
Looking at the data that's available today, certainly there are some significant gaps, I would say, of consumers that are underserved by current, more traditional credit data. People use words traditional. I like to use the words stable, proven, reliable. But certainly there are gaps over there. There are people that simply thin file, no file consumers. And innovative lenders certainly need to continue to look for additional sources of that data. Some of the ones that Mark pointed out are great examples. Other information that's starting to come in that hasn't traditionally been on a credit bureau, like rental data, like subscription data, like data that utility payments, et cetera. These are things that thin file consumers in many cases are making, and they're things that are, again, very predictive of future performance, because that essentially is what credit reports, credit scores do, is they measure the probability that someone is going to pay their obligations as agreed in the future. Past performance is a huge, huge predictor of that, whether it's traditional or non-traditional data.
Great.
So, Angela, I think your question was, what is the future of underwriting? And the future of the underwriting, as far as I'm concerned, is whatever you say it's going to be out there, because you're the innovators in the space. You're the ones doing interesting things. I think we're sitting inside of a market that is, you would probably agree with me, ripe for disruption in terms of the way it's historically been conducted. And we've got probably literally in the audience today 1,000 different ideas about how that should be done. As a company that's been in the data business, if you will, for the past decade or so, we bring a sort of a different approach. And our approach is really to let the crowd decide what's the best way to solve a business problem. And our mission really is to provide that fuel. And the fuel we provide is different than the data that's out there today. It's very real time, it's very fresh, it's very granular. It's on a sort of a real time cycled basis. And our only requirement is really sort of threefold. One is that it's relevant. So it's data about your cash inflows and outflows. The other is that it's accurate. Because the data we deliver is a mirror image of the banking systems of record. It is very accurate, and that's not always the case across credit profiles. And then the third is it's permissioned. So we put the consumer or the small business at the top of the pyramid every single time, and believe very, very strongly that while their contributed or permission data should not be the only source of underwritten data, it should be one that is regarded as most relevant and most useful going forward.
Great, thank you. And just a little further on that, so it seems like every day there's a new banking API startup. And what I'd like to know is, you guys have been in the business for a long time and are quite established. What are some of the lessons that you've learned over this last few years since you've been in the business?
I wish it were only a few years, but it's...
yeah, and you could give a little background.
So, yeah, I'll take you back to 1999 when we founded the company. We actually had 36 different competitors trying to do the same thing, and then at one point or another they all died off in one or two of the boom-bust cycles in the valley, and now they're all sort of going through a resurgence. So there are a few smaller companies, and I think it's great anytime you can bring a differentiated data set into the market or a better way to get or consume or analyze data. I think that's good for consumers. I think it's good for small businesses, and that's ultimately sort of good for us. The thing that I get nervous about, and my colleagues on the bureau side would probably agree, is how is the data being gathered? How is it being handled? Who are the entities in the companies that are controlling that data? And I think a lot of times folks get very focused on the technology of how you get something and how you do something, when we have to keep in mind, not even at the back of our mind, but at the front of our mind, I believe that this is a highly regulated, highly serious industry because it's your money, it's your personal data, and really sort of life-changing decisions can be made upon that data. And if it's not handled, curated, and kept in the right way, I think that's bad for all of us collectively.
Great, thank you. So over the past few years, especially since the financial crash, there's been an increased scrutiny from regulators regarding credit data and services, along with increased customer awareness. How has this affected your businesses, and how is it reshaping the industry as you see it?
Sure. Just to lead off, one of the things that I've been observing or hearing while we've been here at the conference is that there is a large perception that companies such as ours that are represented here on stage are just a credit bureau, something that was founded 130 years ago. But truly, that is just something that we're known for. But in terms of what we describe ourselves as, is that we are aggregators of data and suppliers of data and trusted stewards of data and exchanges that are able to compile and bring them together to provide different insights. So that does include the historical look back with credit scores and whatnot to provide that score. But what it does not include, or what does not get considered in that perception, is the other things that we do, such as the verification of actual data direct from its trusted source. That could include IRS tax transcripts. It could include identities and issuance of EIN numbers or tax identification numbers and SSN numbers directly from the issuing agency, the SSA or the IRS. It's the DDA accounts, as Joe is mentioning. It is education not from the individual, are saying that, you know what, that B minus, you know, I really think I had an off day, so that should be an A, self-reported. We go directly to the institution to provide that data and that trusted method that you all need so you can provide those informed decisions. And I think the way that the crisis has kind of reshaped us is that we acknowledge that the ability to pay and that complete view of an individual being credit, capacity, and collateral are important in those decisions going forward.
And have you guys had a greater interaction with consumers directly now in the last few years? Is that a trend that you've been seeing?
Absolutely. I mean, let's face it. I mean, before it used to be in most of lending transactions where the consumer or the applicant was the third party in the room, that the lender and the various companies or data providers would talk about in third person. Today, with the advent of mobile technology, with electronic records, with social media, the consumer is in charge. And it has to be done in a method that they understand and a method that they accept. And so we have to transform the way that we interact with each other, but also with the consumers, so we can go ahead and deliver the information that they want to deliver to you in the way that they feel is appropriate.
And Angela, if I may, you know, I think a good example of how this is progressing, particularly with our partners, is if everyone I think has seen the Discover ad recently, where the FICO score is available. Through collaboration with our partners, and this is drawn both from, there's some interest from the regulator's perspective, as well as, though mostly the consumer perspective, to have access to the information that's actually used in their score. And we've done this in a relationship through the bureaus so that a participating member in the program, for which we now have somewhere in the neighborhood of 70 or 80 companies working on this, they actually can provide this free of charge. So there's not an additional fee that's charged on top of providing that information to the consumer to help them grow, to teach them how to become a better, more responsible credit user.
Yep, and our customers, the lenders, the card issuers, et cetera, they are seeing increased pressure, encouragement from the regulators to make these scores available, to make credit reports available to consumers, really from the education perspective. I would say the average US consumer is very unaware of their own credit standing. They're very unaware of whether they are a good risk or a bad risk according to their score, what's on their credit report, and anything that we can do to encourage consumers to become more aware of that, both helps them just be aware that the right decisions are being made about them, but also helps them understand what kinds of behaviors can lead to better scores that will help them access credit and get better rates on credit. So this is a pretty virtuous cycle that I think is going to really pay off for the consumer.
So I think, first of all, we don't have consumer customers. So all of our customers are you guys out in the audience, and you know, we exist solely as a platform to help you power your business. So I'm not so sure about the engagement angle of things. I leave that to you. But from a data perspective and from an industry perspective, I think what we found in our years in the business, and we've got now well north of 50 million active consumers on the platform today, is that there are a lot of people that by traditional standards would have a poor credit score or a thin file or even bad credit that are making plenty of money, saving plenty of money. And that's not getting picked up in the current system. It's not being reflected in the current scores. And these are people who actually are going to be the drivers of our economy. These are people out of college and out of graduate school who are starting businesses, who are going to be sort of the mainstay of driving the next generation of economic boom in the United States, and they're having trouble getting credit. And I think part of that is down to the data and how that data is interpreted. And I think, you know, as I said at the beginning, it's an area that's ripe for disruption. You're disrupting it today. You will continue to do so going forward. And I think there's nothing but benefits to be gained by consumers.
So we're at the peer-to-peer lending conference, LendIt. So we should talk about all of your engagements with these companies that are here at the conference. From what I can tell, almost all originators today use your data or platforms as the core of their credit decision and interaction with the customer. Yes, they all have access to alternative data, but the data and services that you provide are integral to this industry's success so far. How has this ride been for you? How have you engaged with these companies, and what are your thoughts of the future of this industry?
Sure. Do you want to?
Sure, I'll jump in.
Okay.
I'll go. So Fair Isaac, most people recognize Fair Isaac by our primary brand, the FICO score. But what often is misunderstood is the fact that Fair Isaac actually, about 80% of our business comes through software and custom analytics. So as I look across the room, we're working with roughly a dozen different companies. And the products that we're offering and that we're working with started our modeling tools. We actually have a modeling tool. We actually have two that we use. One tool is the tool that's used to build our FICO score. And the secondary tool is kind of an offshoot of that that's hosted in the cloud. And what's happened within FICO, if you look at us in the last couple of years, we've actually migrated all of our offerings into our cloud so that it's all available in a much more scalable sense. 3 or 4 years ago, our offerings were not necessarily affordable by companies such as yourself, startup companies. But today, again, as I look across the room, we've recently installed our origination system with a startup company. And within that origination system, there's the capabilities to get access to our analytic tools, as well as integrate within our collection tools, which is also being installed by one of the companies within this room, as well as the key, which came up yesterday, it was in Ron's discussion, which is mobility. Another application that Fair Isaac owns is a mobility app. And what it does is it provides customer dialogue from the point of acquisition through the origination process into collections, as well as into cross-sell and upsell at a later date.
So TransUnion certainly does work with quite a number of the lenders, the peer-to-peer lenders in this room, and look forward to working with quite a few more of you in the very near future. And one of the things that we are seeing is a significant interest in some of those emerging data assets that are coming available. Some of the things that are new to more traditional credit reporting is the addition of new data fields and historical data fields that have never been before available. So think about a credit report has for decades essentially been a snapshot point in time of what a consumer looks like today. The standard credit report that consumers now see on annualcreditreport.com is actually a dynamic credit report that has and takes advantage of 30 months of historical data. So that credit report has gone from being a 2-dimensional to a 3-dimensional view. And certainly both from a risk perspective as well as from a credit demand perspective, seeing what consumers are doing over time. Are you building balances or are you paying down balances? Are you increasing or decreasing utilization? What's your payment ratio on your existing credit cards? Are you paying the minimum or are you paying them in full? And has that changed over time? That's a huge determinant from a marketing perspective as well. So it's not just consumer risk, it's consumer behavior that really is revealed through this 3-dimensional view that really is the future of credit reporting in terms of, again, consumers are getting that today now. Lenders will be using that very shortly.
And do you see a difference in how like an online lender versus a traditional lender, like a Lending Club or Prosper or any of the other peer-to-peer lenders are using your data versus a more traditional bank?
I think that there are potentially different things that they are looking for. So there certainly are those that lenders that target riskier consumers, and many of the models they build are essentially looking for first payment defaulters. If you can identify those people who are going to default on their first payment, never make a payment, and get them out of there, you make a heck of a lot more money. And those predictive tools to better identify that is very different than what a money center bank is going to look for, which essentially is, okay, I've got a high prime consumer. How can I squeeze out a little bit more margin on that? But the other piece, again, is what we see with a lot of the folks that are here is an agility, a nimbleness that you don't see with the large lenders. So the large lenders can look and say, yeah, that looks really cool, but you know what? I don't get fired for doing what I did yesterday, so that feels pretty good to keep doing what I did yesterday. Everyone here in this room, with maybe some few exceptions, but I hope not many, is basically saying, how can I get better? How can I leapfrog the competition? How can I get that step forward? Not in 6 months or a year, tomorrow. You guys have the agility to start using these assets much, much more quickly than the big guys do.
So I think from our perspective, as a platform provider, we engage really 3 ways, and we also are fortunate enough to work with many of the conference participants. The first is quite simply just to give you the raw material that you need that is highly differentiated in the market and that allows you to make better decisions. We don't want to make the decision for you. That's not our job. We know you're the experts at that. So give you that material, let you make the decision. Second is to make that platform just as dead simple as possible to use, which is why if you go to developer.yodlee.com or interactive.yodlee.com, you can get up and running on the API very, very quickly. So get your business going or added into your existing risk management and underwriting schemas. And then the third is, perhaps the most important, in addition to giving you great data and making it easy, is keeping it secure and making sure it's done in a supervised and a regulated environment in a way that, that is not harmful to either the consumers whose data appears in your systems or the other participants in the market in general.
Sure. And just to round it out, similar to Joe, we want to make sure that you have the information that you need, but I think ultimately it's not necessarily about an industry or marketplace lending. You all share a very common connection with other industries, the traditional lenders, government entitlement, credit card, student lending, that you need to take a look at. It's about risk-based decisioning. Some of that is based on credit score, again, that historical look back, but you have to round it out. We as consumers come in all different shapes and sizes. And a consumer is really the starting point of my perspective always, because a consumer is a person who's in charge of their family. A consumer is a person who's the small business owner. A consumer is the person that's running that large company. And so you want to be able to access that information in that secure way as we've been speaking, but also make sure that it's as convenient for them as possible. For instance, we are the largest facilitator of distributing IRS tax transcripts directly from the IRS to the community with the expressed permission of the taxpayer. What is interesting about that is a couple of years ago, it would be irrelevant to mention it to this group, because the only way that the IRS or the agency would allow for the taxpayer to consent was with a handwritten signature. So rather than just saying, oh, that's too bad, I guess we need to find somewhere else to find out about these non-wage earners, the people receiving unemployment, the people with spousal support, the mutual funds, the retired income. Instead, we went to the agency and we worked with them over years to go ahead and enact a policy reform that went into effect January 7th of 2013 that allows for electronic signatures on those consent documents. Most recently, the 8878s and 8879s now allow electronic signatures as you as small business owners or as consumers allow your CPA to file on your behalf. So those are some of the things that we look at to make sure that it's being convenient for the consumer in whatever aspect of life or event that they're going to be transacting in.
Great, thanks. So one of the areas that we, I think, all hope that online or peer-to-peer lending will improve is the credit process for thin file customers. And we touched on this a little bit, and it was discussed a lot in the big data panel. This specifically includes young people, so like the people that Upstart was discussing, and expatriates from other countries. And I certainly know that when I worked in credit underwriting, both of those groups were very hard to underwrite. How have your respective companies worked to improve the experience for these individuals?
So yeah, sure, I'm happy to kick off. We haven't worked to improve that experience at all. What we've done is actually make the data that improves the experience available. And there's literally probably on our platform today somewhere in the order of 4 dozen what I would consider lenders and alternative lenders today leveraging data to do specifically better, more efficient, more effective, more friendly, frankly, underwriting from a conventional perspective. And what they see in terms of, Angela, the case studies that you mentioned, is we can see cash inflows and outflows on a minute-by-minute basis. So we actually know, if you look back at that history, even as short of a time frame as 3 months, 6 months for sure, we've got a pretty good idea how you spend as a consumer going back 5 or 6 or 7 years and how you're going to spend 5 or 6 or 7 years into the future. And so it's really just sort of making that asset available to people who have not had it made available before. And I can look through our data stack of over 50 million users today and show you, a couple 100,000 who probably don't have a credit profile, but they're making more than $1 million a year. No joke. And these are all kids either coming from overseas, to your point, or coming out of grad school and getting big jobs on Wall Street. And they're good credit risks, I would argue, at least from a cash flow perspective, but maybe not from a conventional credit profile perspective.
Mm-hmm. Great. Yep. And similar to Joe, we don't make and have never made any loans ourselves. We power the people that do make the loans. So a lot of what we've been looking to do is how can we get better decision-making tools into the hands of the people that are the lenders. So augmenting our traditional or historical credit report, expanding that credit report, starting to bring in alternative data assets, the ones I mentioned before, rental information, subscription information, utility data, that allows lenders to not necessarily have to say, well, okay, I've tapped TransUnion you out, so where do I go to get some of that other stuff over there? Trying to make it a little bit more of a one-stop shop because they don't want to have to go to 10 different vendors to get the different data assets and bring that all together. Ultimately, at the end of the day, and I can't promise that we're there today, but I think we need to kind of break down this wall between traditional data and alternative or big data. And I think we need to kind of mash that all into one data because lenders at the end of the day don't really care where the data comes from or what it looks like as long as it works and I can reliably get it and the consumer is protected from that data being erroneous or mistaken and having no recourse to make it better. That's really what our charge is.
I think from FICO's approaching it from both the analytics side as well as from the software side. From the analytics side, we can continue again to work with our partners in the bureaus, refreshing our bureau scores. So we're in the process of doing that right now. In conjunction to that, we're also refreshing what we've called our expansion score in the past. And the expansion score is a score that can be used using alternative data sources. So that'll actually be used as a supplement to the traditional FICO score that does pick up data sources. And in this refresh, what will happen, which is different than in the past, it'll actually allow you as the lenders to choose the data source within the prescribed menu of sources that'll be in it to actually trigger that score. From a software perspective, and that'll cover the underserved, the younger population.
Are there any lenders right now that use the expansion score?
It's not being used. There's some users of it, but the score itself is stale, quite frankly. But it is being refreshed, and it should be available hopefully at the end of the year.
Oh, great.
Then secondarily, from a software perspective, as I mentioned before, if you look at our mobility and the interaction that we're working with clients on a mobility basis, everything from the prospect of applying or triggering a loan to soliciting a loan through the collection of it. I mean, I think everyone in the room that has a child that's over the age of 4 knows that's how they communicate. And when you look at the future generations, our platforms are being built all around delivering information and communicating with the consumer through mobility. Again, and it doesn't necessarily have to be just your phone. It could be through Facebook. It could be through other sources.
Sure. And with the thin file, no file population, that's something that we deal with on a daily basis. And that's why close to 7 years ago, Equifax acquired the company that I had worked for, Talks, to go ahead and start beginning to supplement credit and again to move into more of that capacity. Did you know that it takes, on average, 7 years to establish a credit file? For those new to country, for those getting out of school, that can be a long time. That's where the elements, as Charlie is mentioning, utilities, cell phone usage, cable bills, education records, the transcripts, what did they do? How did they pay for their student loan? Individuals that are applying for food stamps, supplemental assistance, healthcare, etc. We're helping them all the time because it's about credit, it's about sources of income, regardless of that income source, being a traditional employer, but also just pulling all those elements together to make it simple, as you said, to aggregate and to make it machine readable, so that way you can go ahead and have the machines digest it and suck it into your system to populate all those scores and calculations that have been mentioned earlier. Because as Professor Barr mentioned earlier, information without context, there is no understanding. So the philosophy that many of us probably share up here is that data is data, combined it becomes information, but if we can help you with that information and provide that analytical insight to make it truly meaningful, so that way you can help the lender, you can help the applicant, you can help the economy, that's when we all win.
Great. So one of the biggest challenges in this space is that there aren't enough borrowers that know about the space, right? So one of the things that we need is to grow the awareness of the industry. And how are you guys helping loan originators find the right borrowers? Or are you?
I think a lot of the data assets we talked about before have some pretty significant applications in that marketing space of being able to identify people that have particular needs to repay other types of debt. So for instance, who is in market for a 3-year installment loan? Well, potentially people who have built up significant balances of revolving debt over the last several years. how can I find those people? How can I find those people and reach out to them and target them to say, hey, we have a tool that actually can help save you money, that can help you pay this down over time, and being able to put those tools into use for those marketing efforts, identifying those behaviors of people who is more likely to respond to an offer from a peer-to-peer lender as opposed to a traditional lender. Well, let's find the people that have in the past and see what we can model to build in there, those propensity models.
Are you guys providing those services right now?
We are absolutely providing services for people that are looking to, for instance, mail a campaign to particular borrowers. Help us find criteria, not just of people who can pay, but are likely to respond to what we're doing. In many cases, that's models that we would build or partners would build, propensity models. In many cases, and that's the beauty of working with the folks like the people here in the room, is you guys have armies of brilliant people back in your own shops who can take that data and actually use that to improve response modeling. So identify who responded to the last campaign. Let's identify what are those algorithms, what are those attributes or variables that are predictive of that, and then let's use that to say, find me more of that. Let's take a population of 250 million borrowers out there and find me the 1 million that really would be interested in a product like we have. Find me those people and let me go after them.
I would say from our perspective, we're actually not helping you find people. We think you're good enough at that as it is. What we're helping you do is make the people you find more efficient for your business.
In what ways?
From the standpoint of being able to underwrite more loans and avoid more good loans and avoid more bad loans. It's really simple as that, just by differentiating the data assets that really allow you to get almost a true 360-degree view of that consumer or that small business on a real-time basis. And that's hard to come by in any one destination, and we've seen really quite an uplift across the customer base in terms of the efficiency, I guess what I would call loan yield or loan efficiency in terms of being able to write loans and place loans that perform.
Sure, I mean, I'll add, in addition to, again, collaborating with our partners around propensity models, different types of analytics, we're also working with one of the participants in the room today through our decision management services. And what we do is our rules engine, our engines drive decisions every single night against their entire population. And they look at those accounts and look at who they should target based on their current status of repayment, their likelihood to respond as well. So it's both an analytics as well as a software technology install.
Right.
And we don't necessarily help source that as well. We do have different services that could help with curtailing kind of a marketing, but it's more about helping determine the eligibility. Based on the rules that you're setting, based on trying to help the borrower go ahead and achieve their dream. So we try to just make sure that the relevant information is available in a trusted, secure way.
Great. So Lending Club and Prosper have done a lot to drive innovation in consumer lending, but now we're seeing a big push into small business. There are many companies here who are either actively or building to actively lend to small businesses. However, I personally worked in small business lending, and I know that the data there is very fragmented and industry specific. Are you guys doing anything to help kind of improve that and work with small business lenders to extend credit in an area where it's very much needed?
So I would say that there's the element of assessing the risk of the small business itself, which means getting that data in, collecting that, and having that available on a significant addressable population. That's difficult to do, and certainly is nothing, that's not a code that TransUnion has cracked. What we do look at, though, is in many cases, lenders to small businesses are, yes, underwriting the business, but in effect, they are taking the risk on the proprietor or the owner of that business, and their personal credit, their personal guarantee is a key piece of that. So certainly, our direct business is indirectly supporting that, but also providing tools that, for instance, allow lenders to look within their existing portfolio of consumer borrowers, consumer customers, and say, who in that group is a small business owner? And we've got tools that can match those individuals to the small businesses to say, I've got a relationship with you already. You've got your checking account, your mortgage, and an auto loan with us today. Hey, by the way, you're a small business lender. Have you thought about moving your small business accounts to us as well? And so helping those lenders proactively reach out to those individuals so they can effectively expand their wallet.
Yeah, I think from our perspective, we're doing two things. One is, if you think about the data we have the good news about you or your business. What do? Do you pay your bills on time? How much do you pay? How much do you make in sales every month coming into your business account or accounts? And we can see that transaction velocity. And so we can leverage that if your credit profile is not as mature as it needed to be to say, well, look, this is a business that we can see going back several years now has been in business. Here's the sort of the average sales per month adjusted for seasonality or whatever analytic you want to put on top of it. And we can see sort of cash inflows and cash outflows, which from a small business perspective, that's one of the key barometers. The other thing we do is actually look on a more broad perspective throughout the whole network, and can we see, are other people in the network buying things at that business, and with what sort of velocity is that occurring? So we can kind of see from both sides in a fairly unique way.
Great, thanks. Do you guys have FICO scores for business?
We do. We actually have it's a broad-based score called the SBSS, or Small Business Score. It's similar to the FICO score, and we also actually have origination systems that are designed for small business lending.
Great. And are any of the online small business lenders utilizing those scores? Do you work with any of them on that, or is it still?
Oh boy, you stumped me. I know there's some in flight. I honestly don't recall if we actually have anyone up and running.
Right.
You got me. I should know. That's one of my segments, but I just can't recall.
And from the Equifax perspective, we do in this country work with some of the providers here in this room with business scores, business profiles, but also around the world in Latin America, Central America, Europe, and the Pacific Rim. So we are providing various scores such as that. But the one thing that's interesting is that with business, you really have to understand that, as you all are well aware, because if it's an established business, that's one type of profile that you're looking at. If it's a person who is just coming out and wants to start a company, there's different elements that you want to pull together to craft that financial picture or aspect of the company or the individual. You want to know what is their percent ownership. What other companies may they have had in the past that aren't necessarily connected to the current business or structure that they are starting up today. So by pulling all that information together, which is available, you can go ahead and start seeing what that risk is and see how you can best put the vehicles or the options forward for that situation so we can all be successful.
Great. All right. Well, we have about 10 minutes left, and I believe there are microphones out there. So if anyone in the audience has any questions.
Has there been, or will there be some sort of coordination amongst the three bureaus to either standardize the traditional FICO score or this new expanded score? Standardizing the algorithm or the method by which that score is derived?
So that was directed at FICO. Even though the bureaus have slightly different data, the actual score that comes out of FICO is normalized across the bureaus. So theoretically, when you pull a bureau score, whether it's from TransUnion or Equifax, the score has been normalized. Now, the truth is, if you pull some and you put them down on the table in front of you, there could be slight variations because of different data that comes through at different timings. So for example, if institution A reports on the 1st of the month and institution B reports on the 15th, that's often the cause of why there could be a disparity, because the information could be updated at a different cycle. But generally speaking, the scores themselves are normalized across the bureaus.
Any other questions?
I think you have them.
There's one over there.
The people in the room here are combining to create sort of unique asset class that has, I would imagine, unique loan performance characteristics. The Bureau attributes, standard aggregated attributes or otherwise, are developed around loans that have been structured as they are and perform according to that structure. It is unclear to me that an attribute that speaks to number of 30-day delinquencies or number of 60-day delinquencies or the performance of these loans will be the same as it will mean the same thing as it always has in the past. I mean, I don't know if that, if you've done any research into that, or if is there a plan to tailor attributes, the standard aggregated attributes that you apply, that you use today for your models. Is there a plan to tailor those or modify those for this sort of unique, potentially uniquely performing asset?
So I would say from the Bureau perspective and building out the attributes that are being used, we are continuing to develop new attributes, new characteristics, new ways of looking at this all the time, both in terms of new advances in the data that's available. So for instance, several years ago, we went through a massive transformation where we went from a 1-byte KOB to a 2-byte KOB, which you may, I don't know what that means. Essentially, it's the loan type. The ability to get much more granular in terms of the loan type that's reported to us and how we report that on the trade lets us build much more granular attributes that look not just at all revolving trades a consumer may have, but differentiate between a credit card, a retail card, a home equity line of credit, other retail types of things. And so we're continuing to build out new attributes that look at that. Now, when I have an attribute that feeds into a model that very well predicts performance on a mortgage or performance on a credit card, and then I look at another type of loan maybe issued by the folks here in the room, the same attributes may not be predictive in that model as would be in the new model, but the reality is we don't tell people who are building models, use these attributes. We tend to basically say, take it all and let SAS sort it out. And essentially, the modelers are able to take massive amounts of data and use that to sort through and say, these are the things that are predictive. And I would expect there to be different attributes that are predictive on a 3-year installment loan that's different than a credit card. But that's the beauty of the fact that we now have more and more data all the time that we're able to make available to those modelers to develop those custom models that really work on a very tailored portfolio like the ones you guys have.
I like your comment about SAS. I'm very familiar with that program.
You've heard of it, huh?
I actually have a question for you. Would FICO has FICO ever considered looking into building a score for this asset class, given that it's different, or do you think that it's performing similarly enough to kind of credit cards or other similar?
Yeah, so FICO, for those of you that are familiar with our score, we have different industry cards. So there's auto cards, there's mortgage cards, much like Charlie was indicating. We have begun discussion around the leveraging and beginning to build an industry card. I would share with you, I don't know the inner workings of where that sits as it is today because I'm not aligned to our scoring group, but the indications I'm getting today is that there's not enough performance for us to build a card, but it's like, you build a house, right? We're starting with the foundation and beginning to collect the data and to analyze the data independently against the various characteristics, because that'll also influence the characteristics that would go into even the prime FICO card.
I think it could be very interesting.
Mm-hmm. If I could add a comment too, I look around the room here and it's a great representation of a lot of innovative minds who really set out and are forming and creating this industry. But you all, many of you are also historical lenders and bankers and such, and you're bringing a little bit of your historical knowledge of that space and trying to apply it here, and it may not be the best fit. Be innovative in the way that you're looking to underwrite. Underwriting is not strictly about a credit score. Underwriting really is evolving into the mitigation of risk and just the prevention of fraud, in the industry to make that best choice. If you as an industry want to rely on self-reported information from applicant, that's going to work well while everything is all sparkly. But at a certain point, you're going to have the individuals that do know about this that are going to try to find the loopholes in this industry and are going to overstate or misrepresent themselves, and then you're going to be in a situation perhaps similar to what mortgage went through. If you rely on scored and modeled income or elements, you will be in a situation similar to what credit card is having to overcome and grapple with today. So I would challenge you to use those innovative thoughts in the underwriting to see scores as an important aspect, but not the only aspect that is out there. Trusted and secure is the important.
So we keep talking about the self-reported, and I understand, especially as having worked in the industry, that self-reported information is tenuous at best. But a lot of the data and the big data that we're talking about and talked about in the previous panel actually isn't self-reported. It's who are your Facebook friends. It is what did you tweet about. Now, I guess in some ways that is self-reported, but if there are trends related to people tweeting about cats, is that really a bad thing to rely on it then?
It may not be a bad thing to rely on from a marketing perspective, but it would be a bad thing to base your income decisions on the number of cat videos a person watches.
I would also say that if all of a sudden big data, the internet thinks that I'm a cat lover instead of a dog lover, and it's wrong, does the internet have a call center I call into to say, that's wrong, correct that? I don't think they do. So, how do you essentially account for the fact that lots and lots and lots of data out there is just flat out wrong and there's no dispute or resolution process?
Yeah, I'm not sure from a Facebook perspective or a Facebook data perspective, but from a financial data perspective, I would view the data that we deliver as consumer permissioned, if not contributed and reported. And by that I mean it's consumer driven from the standpoint of you told me to go get it, but when I go get it, I'm actually getting it through a data feed from the system of record, which is a legal system of record. And so I, as a consumer, if I want to game the system, I can't, because I'm just simply issuing an instruction to get that data on my behalf and deliver it to someone. So there's an inherent check there, I think.
Yes.
All right, we're almost out of time, but I would love to just each of you take just a few seconds as we wrap up to just give everyone in this room sort of your final thoughts and what, if they could take away one thing from what you have to say, what that would be.
You guys are doing an awesome job. Keep it up, and we're really honored to be a part of your businesses. Thank you.
The innovation I've seen in this room and what you guys are pushing ahead in the industry, I think is going to make the lending industry overall better, because you guys are going to be putting the heat under more traditional lenders to start doing things differently, more innovatively. So I applaud you for that. Thanks.
In addition to the innovation, what I'm most impressed with is the time that you act. Coming from our perspective, we've been humbled in a couple of our relationships because we didn't act or react as quickly as you do. We know that we have to become equally nimble as you are, so I commend you for that.
And I would just end with saying that it's not necessarily about an adoption of a process that we're striving for, but ultimately it is a convergence of a mutual experience for that end consumer, making sure that they can adapt, provide, and give you the information that you're looking for so you can help them out with their ask.
All right.
Great.
Thank you, everyone.